Have you ever wondered how normal, everyday people are able to take out $700,000 from their real estate to go buy more real estate? My name is Ricardo Carrillo. I run a nationwide mortgage lending team called RC Lending Advisors, and we cover the entire United States plus Puerto Rico. We help normal people and real estate investors every single day who are looking for properties or trying to tap into equity in their existing real estate across all markets. One of the things that has allowed for me to be able to see what are investors doing in different markets is the fact that we cover all 50 states. And it allows for me to see where real estate investors are going, what kind of strategies are they wanting to utilize, and how are they making their money, and how are they making their properties profitable. I love this strategy because it allows for me to go and talk to my other investors and my other clients who are wanting to do the same thing but don't even know where to start by just simply doing deal of the week videos just like this one. In every single video, I talk about an existing property or a client of mine who we've helped in the past structure a deal, and I walk you guys through the financing, how we made it work, what the client did in order to qualify, and how they're going to continue to use this to go buy more real estate. This is a really unique deal of the week that I want to talk to you guys about today because it's a client of mine who has a really cool property. You guys, if you've watched some of the deal of the week videos in the past, you've heard me talk about this idea of house hacking. And house hacking is simply where you live in one property and you rent out the other units. Let's say you live in one bedroom and you rent out the other units or the other bedrooms in your house. Or in a case like this, you live in one house that's on your property, but maybe you have other structures or a cabin or something else on the lot that you are able to rent out and go make money off of. This property is located in Austin, Texas. It's a multifamily sitting on 3 acres, and it was different houses on these 3 acres. And so there's multiple properties across the land, which allows for the client to do a successful house hack where you live in one unit, you rent out those other units on Airbnb. Now, Austin, Texas is a very popular short-term rental market. I've had a lot of investors who've bought with us in Austin, Texas, and have been very successful. There is a lot of traffic for people who are always going to Austin for vacation rentals and wanting to book properties of this size. When you have a bigger property, you're able to do more. You can create a lot more amenities. You can do things like a golf course. You can do volleyball courts, pickleball courts, tennis courts, sand pits. You can literally do anything and everything that you want when you have more land to play with, which makes it way more attractive for somebody to want to come and book your place, to then obviously pay a little bit more than what they would spend if they were to stay at a hotel. And when it comes to short-term rentals, it's all about exclusivity, and it's all about giving them an experience that's going to be different than what they would normally pay for if they were trying to stay at a hotel, right? And so this property sits on 3 acres. It was a massive multifamily house. Total living square footage was 3,316. It's a 4-bedroom, 4-bath house. That's just what it's labeled as, but we know that there's more structures there. And we structured this as an investment deal for our client simply because of the fact that primarily it's used as an investment. It's very rare that he spends some time there. And even though he house hacks the property the majority of the time, he's not really there. Loan type, we ended up doing a DSCR loan. Now, DSCR stands for debt service coverage ratio. It's essentially just saying, can your property cover its own mortgage payment? So if you have a $10,000 a month mortgage and you're renting your property for $10,000 a month, it debt services, it can cover the mortgage. That's basically what lenders are looking for when they're doing this kind of loan, where you don't even have to have income in order to qualify. We don't need taxes, we don't need pay stubs, we don't need W-2s, we don't need 1099s. It's so simple because we just collect things like bank statements, a driver's license, and your mortgage statements, and then finding out, how does your property rent out? Do you rent it out on a long-term rental basis? Is it a short-term rental like this? Are we able to use websites like AirDNA, for example, where we're going off of projected revenue? So it's very interesting as we start to look at alternative kind of financing options that allow you to go buy more real estate, but without having to have income and without having to qualify like traditionally, right? Most people are used to, I'm gonna go walk into Chase Bank and I'm gonna get this specific pricing, but I have to have these programs that I'm falling under. And when you're working in that structure, it's a lot harder to qualify if you don't fit the box, right? And many of our investors don't fit cookie cutter boxes, which is why they end up working with a team like ours in order to go buy more real estate. This was a cash out refinance. So we did a cash out refi. And a cash out refinance is essentially where you already own a property and you're wanting to pull money out of your property. And one of the things to note with a cash out refinance is that you always have to leave a certain amount of equity in your property before you're able to withdraw money, or you have to have enough equity in the house. Now, this client already had his property paid off, and crazily enough, the property actually ended up appraising for 2.47 million, which was phenomenal, almost 2.5 million. And we didn't need to pull all the money out, although we could have, and we ended up only doing 700,000 in order to get the money out of this property. And that made it so that the client was able to secure a huge amount of capital to do all of the upgrades and be able to rent out the property significantly more. And one of the things that we already knew was, because of the revenue, that this property was going to be able to cover the mortgage, and we weren't going to have any other problem with qualifying. So loan to value was actually super low. It was 28%, which is extremely low. Loan to value is just how much of a loan do we have relative to the value of the property. And because our client was under a 50% loan to value, he actually got the best pricing that exists. And so we were able to do a 30-year fixed term for the loan, 30-year fixed at a 6.375%. Now, at a 6.375%, it made it so that he was able to have a lower monthly payment that we knew was going to be able to cover the mortgage with the rents. And we weren't going to have a problem with qualifying either for the debt service loan, because we had so much income to play with. In fact, we could have even gone higher. It was just mainly that our client didn't need all the money. So, it's one of those situations when you're thinking, can I pull more money out of my house? Should I pull more money out of my house? It just depends on what are you going to go do with that money, and are we calculating and running the numbers? At the end of the day, I always say, if the numbers make sense, then the deal will make sense. And in this situation, nothing changes. It's the same thing. We want to make sure that you have enough money coming in to cover the mortgage. And if you're going to be over leveraged, well, let's make sure that whatever money you're putting, whatever deal you're buying and putting this money into, that is also going to be able to help cover the payments on this deal. That's what I always say about things like home equity lines or home equity loans. We want to make sure that if you're going to be over leveraged, that you can cover the payments and you're not going to have a problem. Now, there was no previous monthly payment besides property taxes and homeowners insurance. And so I'm just going to leave those blank here. But jumping into the monthly payment here, we had principal and interest coming in at $4,367 with 9 cents. PMI, there was no PMI on this kind of loan program. Any non-conventional loan, you actually don't have PMI. DSCR is a type of non-conventional loan, and so there was no PMI. Homeowners insurance was really high. We had $1,100 in homeowners insurance, mainly because of the policies that our client had in place for short-term rentals to have a lot more protection, and because it's a multifamily sitting on 3 acres. Property taxes in Texas, unfortunately, are significantly higher than what you would expect out of most states. And so that was actually $1,550 with 86 cents. There is no HOA in this area. It was an unincorporated area, which was phenomenal for him. And that actually brought our total monthly payment here to $7,081 with 18 cents. Now, jumping into closing costs, one of the things that we had done was we actually paid a lot for the interest rate that we were getting at the time. And that was what led to our closing costs being higher. But we also had a lot of homeowners insurance, flood insurance, as well as property taxes and other things that were being paid at closing, which left our total closing costs at $65,967 with 72 cents, which is way higher than normal. You guys know that I typically suggest budgeting between 1% to 2% of the total loan that you're getting for closing costs on a refinance. So this was a kind of a different number here than we were expecting, mainly for that reason. And then there was no adjustments here since this was a refinance. There was no previous loan payoff since the house was already paid off. And we didn't end up consolidating any debt on this deal either, which we have the ability to do so on a cash out refinance like this. So it actually left our client walking home with $637,134.24, which is amazing. If we think about the perspective of how could you be leveraged on a deal where, let's say somebody who doesn't have a job, oftentimes they're going to have the impression of, I'm not going to be able to go get a loan because I don't have a job. There's no loan programs that exist for me. When frankly, that's just not true. That's a huge misconception, because big banks like Chase and Wells Fargo and US Bank, they don't want you to know that other programs like this exist, ultimately because they don't offer it. And so why are they going to talk about it, right? But the thing is that just like people go onto Expedia and they want to find airlines and see, which airlines are giving better deals, the same thing applies to us. We're essentially the Expedia, but for mortgage lenders. We do the exact same thing where we will see all of our banks and see what kind of loan programs make sense. And For me, I'm always going to explain to my clients, it's always going to make sense for us to do a deal where we know you're going to be able to go succeed with whatever you're trying to do with the money, right? And for me, I always look at a full financial profile. I want to make sure that, hey, if we are taking $700,000 out of this property, what are we going to go do with it? Can we make sure we cover the payments? Can we make sure you're going to be more profitable? And can it help you build more generational wealth? I think those are the biggest things that our clients are looking for when it comes to structuring a deal like this, but also understanding there's so many loan programs that exist. Even if you think that you might not qualify, it's always worth a conversation. I hope that you guys found this deal of the week informative. If you haven't seen my other deal of the weeks, please check those out here. We're always dropping some really cool structures to financing that you probably haven't even heard of. And if you guys have stuck around this long, I very much appreciate you. Like and subscribe to the videos. I will see you guys in the next deal of the week.